What is happening, crypto fans? Welcome back to Bitcoin Bulletin, your ultimate source for the most electrifying updates shaking the digital asset universe. Get ready, because the pace of news is absolutely blistering, and if you're not plugged into this, you're missing out. We've got major shifts, sharp corrections, and critical insights that could redefine the landscape. Buckle up, because you're about to get the unmissable rundown that'll keep you ahead of the curve. First up, the market might be shedding some of its less committed participants, a move some analysts are calling a necessary shakeout, potentially paving the way for stronger hands to take control. Is this a sign of resilience or a precursor to further turbulence? Let's find out. And that's just the beginning. Next, we're diving into a wild price swing that saw Bitcoin plunge thousands of dollars in mere minutes. What triggered this sudden, dramatic drop, and what does it mean for the broader market? We've got the details on a massive whale sell-off that sent shockwaves across the entire crypto space, leaving investors scrambling to understand the fallout. But the story doesn't end there. We're also breaking down how Bitcoin's price action is diverging from its digital counterpart, Ethereum. While one faces significant downward pressure after that whale sell-off, the other is showing surprising resilience. What are the technical indicators telling us about this split performance, and where do these assets stand now? And finally, we're looking at the bigger picture, exploring how institutional adoption and a new capital paradigm are shaping the long-term trajectory of Bitcoin. Are we witnessing a fundamental shift in how major players are entering the market? Stick around for all the critical insights, and make sure you're subscribed and the notification bell is on so you never miss an update. Let's go. Market shakeout underway. Are weak hands being purged? Recent data and analysis suggest that the Bitcoin market might be undergoing a significant, albeit potentially healthy, correction. Observers are pointing to a trend where newer investors, often described as having less conviction, are selling their holdings at a loss. This phenomenon is being characterized by some as a market shakeout, a process where less committed participants are exiting, allowing more experienced or resilient investors to accumulate assets at potentially lower price points. According to Analyst, investors who have held Bitcoin for less than a month are realizing an average unrealized loss of approximately 3.5%. This has led to a measurable decrease in the supply held by this cohort. Krasablock has labeled this trend as a classic capitulation, driven largely by fear and a lack of long-term commitment. In contrast, short-term holders who have been in the market for a slightly longer period, typically under 180 days, are still showing a cumulative unrealized gain of around 4.5%. This indicates a divergence in market sentiment and holding behavior between different investor profiles. The analyst further elaborated that the reduction in the overall supply from the newer, less committed traders is a direct consequence of this tourist capitulation. The implication, as seen by Krasablock, is that Bitcoin is being transferred from those with less conviction to holders who possess a lower cost basis and a higher degree of confidence in the asset's future. This transfer of assets is viewed as a positive signal, as it purges the market of potential panic sellers and establishes a more solid support base for future price appreciation. Essentially, the market is purging its weakest hands, which can lead to a more robust foundation for upward price movements. Adding another layer to the market sentiment, Gordon Johnson, head of GLJ Research, has issued a stark warning, suggesting that Bitcoin could be at risk of a 65% collapse. Johnson's concern stems from a contraction in dollar liquidity within the U.S. financial system. He specifically highlighted the complete depletion of the Overnight Reverse Repurchase Agreement, ONRRP facility, an indicator that has not reached zero since 2021. Johnson posits that this depletion signals an impending liquidity crunch, similar to what was experienced in 2022, unless the Federal Reserve alters its quantitative tightening, QT, policy and pivots back to quantitative easing, QE. This macroeconomic factor, independent of individual investor behavior, poses a significant risk to the cryptocurrency market. Furthermore, analysts at Glassnode have corroborated the notion of a weakening market sentiment. Their recent report indicates a transition from a state of euphoria to one of fragility. This fragility is evidenced by the fact that spot Bitcoin ETFs have experienced outflows for 6 consecutive trading days. Sentiment, another analytics firm, noted this streak, comparing it to the outflows seen during a period of tariff fears in early April. Sentiment's analysis suggests that these inflows and outflows may increasingly be driven by retail traders, rather than the institutional players who dominated the early phases of ETF adoption. Retail investors, being more susceptible to emotional decision-making, tend to withdraw funds during perceived market peaks, which can exert temporary downward pressure on prices. However, sentiment also suggests that such behavior often precedes the formation of a local market bottom, mirroring patterns observed in April. Adding to the outflow narrative, investment products based on digital assets collectively saw outflows totaling $1.43 billion between August 16th and 22nd, marking the largest such outflow since March. This significant capital withdrawal underscores a broader trend of investors de-risking or reevaluating their positions in the current market environment, influenced by macroeconomic concerns and potential shifts in liquidity. But is this shakeout a temporary blip or a fundamental shift? We'll explore the forces driving these market dynamics next. Bitcoin's sudden plunge, a whale's farewell or market meltdown. In a dramatic turn of events that sent shockwaves through the cryptocurrency sphere, Bitcoin experienced a precipitous drop of $4,000 in mere minutes, triggering a broader market sell-off that saw major digital assets tumble. This rapid decline, often termed a flash crash, erased an estimated $100 billion from the total crypto market capitalization within a 24-hour period, leaving investors bewildered and analysts scrambling for explanations. The sudden volatility underscored the market's sensitivity to large-scale movements and underlying macroeconomic pressures. The primary catalyst for this sharp downturn appears to have been the liquidation of a substantial Bitcoin holding, reportedly amounting to 24,000 BTC, valued at over $2 billion. On-chain data and social media reports indicate that a significant portion of these assets, specifically 12,000 BTC, was moved to a trading platform known as HyperUnite, with a large volume being sold within a single day. What amplified the impact was the nature of these holdings. Many of the coins involved had remained dormant for over 5 years, suggesting a potential liquidation event by a long-term holder, which exacerbated the downward price pressure. This massive sell-off has significantly shifted market sentiment, with traders increasingly bracing for further declines. Sean Dawson, head of research at the options platform Derive, Zeiss, noted a palpable shift towards downside protection, evidenced by a negative 25 delta skew for both Bitcoin and Ethereum. This indicates a growing preference for put options, bets on price drops, over call options, bets on price increases, a trend not seen with such intensity in 2 weeks. Consequently, Dawson has revised his forecasts, increasing the probability of Bitcoin falling back to $100,000 by the end of September from 20% to 35%, and for Ethereum to retreat to $4,000 from an unspecified percentage to 55%. Adding to the complexity, David Hernandez, a crypto investment specialist at 21 Shares, pointed to the influence of recent macroeconomic data, particularly the Personal Consumption Expenditures (PCE) inflation report. This report could either propel Bitcoin towards $120,000 or, conversely, dampen its momentum further, depending on the Federal Reserve's subsequent policy response. Vincent Liu, Chief Investment Officer at Chronos Research, offered a different perspective on the sell-off, suggesting that it was more likely the action of multiple large holders or institutional players rather than a single whale, implying a more coordinated or widespread distribution event. The broader implications for market stability are also under scrutiny. Alex Kupcikevich, FX Pro's chief market analyst, observed a notable shift in liquidity, with capital moving away from Bitcoin towards Ethereum and other altcoins like Solana. However, he cautioned that the selling pressure experienced by Bitcoin could potentially spill over to other assets, creating a contagion effect across the market. This rotation highlights the interconnectedness of the crypto ecosystem and the potential for cascading effects from significant price movements. Despite the recent volatility, Bitcoin managed to hold above the $110,000 level, although it has dipped below its 50-day moving average. The market is now intently focused on whether this correction represents a short-term fluctuation or the beginning of a more sustained downturn. The interplay of whale activity, institutional sentiment, and macroeconomic indicators will be crucial in determining Bitcoin's near-term trajectory. While Bitcoin navigates this sharp correction, its digital cousin is showing a different story. What's keeping Ethereum resilient while Bitcoin falters? Bitcoin dips, Ethereum holds, navigating divergent fortunes. In a turbulent market session, Bitcoin experienced a significant price weakening, dropping towards key support levels near $110,500 following a colossal $2.7 billion whale sell-off. This substantial transaction triggered a cascade of automated liquidations across the market, contributing to a broader market capitalization dip to approximately $3.83 trillion. The event highlighted the potent impact a single large transaction can have on market dynamics, especially in an environment already sensitive to volatility. Technical indicators reveal a growing divergence in performance and outlook between Bitcoin and Ethereum. For Bitcoin, the average directional index, ADX, stands at a low 16, coupled with a relative strength index, RSI, hovering near 42. These metrics signal a weakening trend conviction and increasing selling pressure. Furthermore, the squeeze momentum indicator points towards potential choppy price action and heightened volatility ahead, suggesting that the immediate future for Bitcoin may involve continued uncertainty and price fluctuations. In contrast, Ethereum is demonstrating a more robust technical profile. Its ADX is positioned around 41, indicating stronger trend momentum. The moving average convergence divergence, MACD, shows a bullish 5200 exponential moving average EMA spread, a classic sign of sustained positive momentum. With an RSI near 59, Ethereum maintains a more favorable position, suggesting continued upward pressure and resilience in its price action. This divergence underscores a potential shift in market preference or a different response to the prevailing macroeconomic and market-specific events. Given the elevated uncertainty and the contrasting technical signals, traders are being advised to prioritize risk management strategies. For Bitcoin, critical support levels are identified at $110,500 and a tighter range between $107,000 and $107,600. Resistance is anticipated at $116,000 and potentially $120,000. Ethereum, on the other hand, finds support within the $4,194 to $4,400 range, with immediate resistance expected around $4,954. Market participants are recommended to adopt cautious trading approaches. This includes tightening stop-loss orders to limit potential downside, reducing leverage to mitigate risk, and waiting for a clearer resolution of the current volatility before committing to new positions. The recent whale-induced price action serves as a stark reminder of how swiftly market conditions can change and how critical it is to stay informed about the underlying forces at play. While Bitcoin's trend conditions appear fragile, Ethereum's technical strength offers a degree of stability, making it crucial to monitor these diverging paths closely. But beyond these immediate price movements, what fundamental forces are shaping the long-term future of Bitcoin? We're looking at institutional adoption and a whole new capital paradigm next. Bitcoin's secular ascent, the institutional influx, and a new capital era. The narrative surrounding Bitcoin is increasingly shifting from its speculative origins to its role as a significant asset within the global financial system. A key driver of this evolution is the growing institutional adoption, which is fundamentally altering the capital paradigm and paving the way for what many are calling a new era for digital assets. This influx of institutional capital is not merely about increased trading volume. It represents a fundamental validation of Bitcoin's potential as a store of value and a medium of exchange in the 21st century. Historically, Bitcoin was primarily the domain of retail investors and early adopters. However, recent years have witnessed a marked increase in interest and investment from large financial institutions, including asset managers, hedge funds, and even publicly traded companies. This trend has been significantly accelerated by the introduction of spot Bitcoin exchange-traded funds, ETFs, in major markets. These financial instruments provide a regulated and accessible pathway for traditional investors to gain exposure to Bitcoin without the complexities of direct custody or trading on cryptocurrency exchanges. The impact of these institutional flows is multifaceted. Firstly, it has contributed to increased market liquidity and stability, reducing the volatility that once characterized Bitcoin's price action. While sharp price swings still occur, the underlying market structure is becoming more robust due to the sustained buying pressure from institutions. Secondly, institutional involvement lends a degree of legitimacy and credibility to Bitcoin, attracting further investment from both retail and corporate entities alike. This creates a positive feedback loop, where increased adoption leads to greater acceptance, which in turn fuels further adoption. Furthermore, the integration of Bitcoin into traditional financial products and services is creating new avenues for capital deployment. As more institutions allocate capital to Bitcoin, it signals a recognition of its potential as a diversifier in investment portfolios, offering uncorrelated returns to traditional assets like stocks and bonds. This shift is indicative of a broader trend where digital assets are being incorporated into mainstream investment strategies, driven by the search for yield and the potential for significant long-term growth. The new capital paradigm refers to this fundamental restructuring of how capital flows into and interacts with the digital asset space. It signifies a move away from purely speculative interest towards a more sophisticated understanding of Bitcoin's technological and economic properties. Institutions are not just betting on price appreciation, they are investing in the underlying blockchain technology, the network effects, and Bitcoin's potential to disrupt traditional financial systems. This long-term perspective is crucial for the sustained growth and maturation of the cryptocurrency market. The implications of this institutional embrace are profound. It suggests that Bitcoin is no longer a fringe asset, but a recognized component of the global financial landscape. As more capital flows in, and as regulatory frameworks continue to evolve, Bitcoin's role is likely to expand further, potentially impacting everything from monetary policy to global trade. The current phase of institutional adoption represents a critical juncture, marking Bitcoin's transition into a more established and integrated asset class. And that wraps up our deep dive into today's biggest stories. But before you go, let's quickly recap what we covered. And that's a wrap on another action-packed Bitcoin Bulletin. We saw a potential market shakeout as weak hands exited, a dramatic flash crash triggered by a massive whale sell-off, a divergence in performance between Bitcoin and Ethereum, and a look at how institutional adoption is shaping a new capital paradigm for Bitcoin. Don't miss out on the next wave of updates. Hit that like button, subscribe to the channel, ring the notification bell, and let us know your thoughts in the comments below. For more insights and real-time updates, follow us on all our social media channels. Stay informed, stay ahead.